Hi, good evening, everyone. Now, welcome to our Let's Learn Futures webinar series. This webinar series is brought to you by Bursa Malaysia and managed by our company, Excellent. Now, we have a very interesting topic for this evening, a practical guide to hedging and risk management using futures contract. I'm not quite sure whether you heard about this hedging, the terms hedging, whether you heard about risk management. So we are going to cover these two concepts for this evening. So this evening, we are going to separate into two different sessions. The first 60 minutes will be covered by our speaker for this evening, CY So Chun Yen, followed by 30 minutes of Q&A session. And I'm the moderator for this evening. My name is Ting Ting. Now, before we start, as usual, please make sure that you can hear our voice. You can hear my voice. You can see my slides. If you can hear my voice, you can see my slides. Can you please just type in the chat box 222? I repeat, if you can hear my voice, you can see my slides. Can you please just type in the chat box 222? Very good. I saw someone already typing in. How about the rest? Can you hear me or not? Okay. Very good. Well done. Now, as usual, please off your video so that you can have a very smooth session, as video will take out a lot of your bandwidth. So if you are currently on your video, I'm going to give you 2 seconds. Yes, 2 seconds only. So please just off your video. Now, as usual, along the way, if you have any question, please type in your question in the Q&A box, meaning that while Siwa is presenting, if you have any question, you do not need to wait until the end of the session. Along the way, you can type your question in the Q&A box. What can you do is you can click on the Q&A box. Can you see that? At the bottom, some of you, if you're using tablet, it might be at the advanced tab. Then you click on the Q&A box. Then you type in your question and send it to all co-hosts. Please remember to send it to all co-hosts. If not, I will not be able to pick your question up. Now, please remember, do not type your question in the chat box, because once you type your question in the chat box, I might miss out your question. You're going to see that the chat box is going to be flowing very fast. So any question, please type in the Q&A box. Subsequently, at the end of the session, we're going to open the question for our speaker to answer. Now, no need for today's session. For those who already joined us for many sessions, you should know that every Tuesday, we're going to have different topics, different language covered by different speakers. So you can see that upcoming for next Tuesday, we are going to have a Mandarin session, followed by 24th of September is a Malay session. And on 1st of October, we are going to have it back in English session. You're going to see that 1st of August is an English topic about Higanashi. So if you have any session that you are interested, what you need to do is you can scan on this QR code, or else in the chat box, there's a link. You can click on the link to join the session. Please register as soon as you can so that there's a reminder will be sent to you. You can remember that you need to attend the webinar session. So every Tuesday, different topics, different languages covered by different speakers. So any session that you're interested, you can scan the QR code and register accordingly. Alternatively, you can take a photo or you can screenshot and you just click on the link, or you can scan on the QR code to register accordingly. Now, not only Let's Learn Futures webinar series, Bursa Malaysia also lines up a series of Let's Learn Futures online workshop for you to participate as well. So this online workshop is not suitable for everyone. This online workshop is for those who are seriously getting started in your futures trading. Then only you participate, because this session is very limited space available. So we have online workshop 1, the complete guide for beginners to futures trading and trading simulation, and followed by online workshop 2, how to create an effective futures trading plan and trading simulation. So I strongly advise you to go and participate. If you do not have any ideas or you have not yet started your futures trading, I strongly encourage you to go and participate in this online workshop. So scan the QR code and register accordingly. Now, Before I pass it over to our speaker for this evening, I would like to have a very quick introduction about our speaker for this evening. I believe many of you already know Mr. C.Y. So, and he's currently the lead trainer for Excellent, and he's also the lead hedging and risk management consultant for Excellent as well. He is currently also a chartered market technician, chartered holder, and he has over 11 years of trading experience in local and also international stocks and futures trading. His specialty is in trading system and strategies, trading psychologies, risk management, and also hedging. So without further ado, please allow me to pass it over to CY.
Hi, good evening, everyone. I hope you are all doing well. And I'm excited to welcome you all to today's session on a practical guide to hedging and risk management. My name is CY, and I will be guiding you through today's key topic related to risk management. Oftentimes, most people don't think about risk or managing risk until unfortunate event happens. Now, that's not a good way to manage risk because the damages has already happened, losses has already occurred, and there's very little thing that you can do. So in the world of financial markets, volatility and uncertainty is always there. So understanding how to manage risk is very crucial. It is not just only applicable for those large corporations or institutions, but risk management is also applicable for any individuals or entity looking to protect your assets as well as your investment. So today we are going to break down the concepts of hedging and risk management into practical and actionable steps that you can apply in your trading. So I believe as you participate in this webinar, it shows that your commitment to safeguard your trading and investing account and deepening your knowledge, deepening your understanding of how to navigate through the market volatility. So whether you are seasoned professional looking to refine your strategies in risk management, or someone who are new to the field of futures trading, there will be valuable insights and tools that you can take away from this session. So our focus for today will be on practical applications, how you can implement risk management and hedging strategies that align with your risk tolerance and financial goals. And I encourage you to ask questions at the end of this session and engage in the discussions, as this is how we will learn most through the interactions. So by the end of this webinar, you will have a clearer understanding on the key principles of hedging and risk management, and you will be equipped with the knowledge to apply these strategies in your own futures trading. Before we begin, I want to give a quick disclaimer. This presentation is for educational purposes only, and it is not intended as an investment advice to buy or sell futures contract. So in this today's webinar, I will be sharing with you some risk management and hedging strategies that are applicable to futures trading. What I share with you in this webinar are just for your reference to improve your knowledge about enhancing the risk management process in your trading. That being said, I hope that today's session will help you widen your horizon and expand your knowledge about risk management in trading. As Ting Ting mentioned earlier, my name is Chun Yan. You can simply call me CY, and I don't have to elaborate a little bit more. And let's dive into today's topic. Now, today I will be dividing into 4 key topics that will help you understand the concepts about risk management and hedging. So we will begin with topic 1, the significance of risk management in trading. Here I am going to share with you why it is important for you to manage your risk in futures trading, and follow up with the practical risk management strategies. So topic number 2 will be a little bit heavy here. I'm going to go through the fundamental factors about some of the strategies in risk management, how you can do your cut loss, what are the things that you can do to minimize your risk in futures trading. Thirdly, I will share with you some of the fundamentals about hedging, and last topic 4, we will be looking at what are the hedging strategies with futures, because a lot of retail traders, they don't understand about hedging. But in fact, when you know what is hedging, and especially in Malaysia markets, we have futures market, we have index futures, and this is where you can actually use futures contract to protect your stock portfolio. So in topic 4, I will be sharing with you how you can do that. So are you ready to take your futures trading to the next level or not? If you're ready to do that, can you type in yes in the chat box, and let's get started. Now, in this topic, I am going to share with you why it is important to manage risk in futures trading. Without risk management, it's difficult to succeed in the long run in futures trading. Later on, I am going to justify to you why risk management. In fact, it's actually personally for me, it's the number one thing that determines whether you can do trading for a long run. Now, before we get started, I would like to know, what does risk mean to you in trading? You can type in your answer in the chat box. Share with me what is your perception about risk in trading. Don't worry, there is no right or wrong answer. I would like to know, what does actually risk means to you, because different people might be seeing risk very differently. So share with me what is your perception about risk in trading. You can type in maybe one words or one short phrases. That's fine, so that all of us are able to see, different people actually see risk very differently. So I see some of your answers here. Most of you put losses. Some put capital protection. All right, some type in uncertainty and damages. All right, very good. Now you can see different people would see risk very differently, and some of you might also say, not achieving desired results. All right, it's also another way of looking at it. Now, throughout this session, you will be able to see what is actually risk is, and how you can actually manage that. So while some of you, when you answered what is risk, some of you are a little more positive. Some people might say risk is actually opportunity to make good return. Okay, this is actually one of a positive way to look at risk. So in the domain of finance and risk management, risk can be broken down into many specific types of risk. So you can see there is a whole list of risks here, such as market risk, liquidity risk, interest rate risk, inflation risk, operational risk. There are even a lot of risk that is very specific in these terms. Of course, you do not need to understand all of these risks, because it can be confusing, and I want to share something that is more relevant and easier for you to understand. No matter what risk that you face in the market, it all boils down into one thing. To make it simple, risk refers to any potential financial losses when you engage in investing or trading activities. So let's say, for example, initially you enter a trade. You don't face any profit and loss, right? Your result would be equals to zero. Now, question oftentimes when we ask about ourselves is that whether can we be sure we will be making profit in a particular trade, and how much profit that we are going to make, or how much losses. So to make it simple, any potential price movements that can let you make money or profit is what we call as the return or opportunity. And likewise, the opposite side would be any potential price movements that can let you lose money or lose money is what we call as risk. Now, this includes when you enter the market at the wrong time, there is no risk control, no cut loss, trading too big, over leverage, and many other, sometimes we call it stupid things that we do in trading that cause us harm or loses money. So to make it simple, effective risk management strategies such as setting stop loss orders, diversifying your portfolio and strictly follow to a well-defined trading plan are actually very crucial to manage all of this risk. Now, futures has many other risks as well, but today I'm going to highlight one specific risk when it comes to futures trading, because one unique risk in trading futures compared to investing or trading in the stock market is that futures has this risk is what we call as the leverage risk. Meaning, you just need to come out with a small capital that fulfill the margin requirement. You can actually have a large buying power. So this will actually magnify your return when you make money. Likewise, it will also magnify your losses when you lose money. So leverage in futures trading is actually a very powerful tool that allows traders to control a large amount of asset with relatively small amount of capital. So this means that you can make a potentially large profit from a small investment. However, it is important for you to take note that with leverage, it also increases your potential losses. So while the potential profit is great, so is the potential loss. So let's have a look at an example. What do we mean by leverage in futures trading? So for example, let's say you want to buy a futures contract for FKLI, but you only have $4,000 to invest. So let's say currently FKLI is at 1,600 points. So multiply by per point is $50. So one contract of FKLI is actually worth 80,000 ringgit. So currently what you need is that as long as you fulfill the initial margin requirement of 4,000 in your trading account, you can actually you can actually trade one contract which actually control this $80,000. So you can see relatively, instead of putting $80,000 to invest in the whole Malaysia market, you just need to come up with 5% as your margin requirement, a minimal deposit to actually control this 80,000. So now let's say the general market is up by 3%. So 3% of 1,600 points is actually 48 points. So if you use 80,000 ringgit to invest in a well-diversified portfolio that tracks the Malaysia index, your stock portfolio follows the general market, which is up by 3%. So simply speaking is that your stock portfolio is actually up by 3%. However, if you are in the futures market, one FKLI contract that tracks the overall market, 1% up is 48 points times $50 per point. So your profit for one contract would be $2,400. But you can see, because you are trading futures contract, right? You are not coming up with 80,000. You just need to come up with $4,000 only. So you can see the return in futures trading with 4,000 to make 2,400 is actually 60% return. So comparing with investing using the full amount of 80,000, using futures contract can indeed magnify your return because you have leverage. So if the price of FKLI goes up, you make larger profit. If you had simply invest 4,000 outright in the futures market. However, same thing, if the price of FKLI goes down, you can potentially lose more than your initial investment as well. Now, another example, let's say currently the FCPO is trading at 4,000. So multiply per point $25 per metric ton. So one contract of FCPO is actually worth 100,000 ringgit. So trading futures, again, you don't have to pay the full amount of 100,000. With leverage, with just the initial margin, currently is 7,000 ringgit, you are able to control 100,000 worth of FCPO in just one contract. So it's just only 7% of your total value. Now let's say the FCPO market is up by 3%. So if you use a full $100,000 to invest in crude palm oil, your return is only 3%. However, if you are in the futures market, one FCPO contract 3% up is 120 points times $25 per metric ton, and that would be equivalent to 3,000 profit in your futures trading, just only one contract. And the return is 42.9% return, because you only using $7,000 to trade. So you can see, comparing with investing using the full amount of 100,000, using futures contract can magnify your return because you have leverage. You don't have to come up with a full capital to make $3,000. You just need to come up with a fraction amount of money to make this 3,000 ringgit. So this is what we call leverage in futures trading. So same thing, if the FCPO price goes up, you make a larger profit. If FCPO comes down, you can also potentially lose more than your initial investment. So to conclude is that it's important to use leverage wisely, and only when you have a solid understanding of the risk involved. This is where you should always have a risk management plan in place to help you protect yourself from excessive losses in futures trading. Now, why is risk management is crucial in trading? Now, number one, of course, you are able to protect your capital from significant losses. It's important for you to preserve your trading capital to survive in the market in the long run, so that the losses you encountered will not significantly impact your ability to trade when there is a future opportunity arise. Secondly is that you can manage risk that is associated with leverage, as I've shared with you in the previous few slides, how leverage can amplify both gains and losses. So risk management can safeguard you against excessive losses, especially when you are wrong in a particular trade. Risk management also ensures your long-term trading success, so that you are able to have consistent application of these risk management strategies that leads to sustainability in your futures trading. And lastly, with risk management, you are able to reduce emotional decision making, because when you have especially when you have a structured risk management process, it can reduce the impact of trading with too much emotion. If you don't have any risk management in plan, when you lose money, it's pretty emotional situation. So you might be attempting to trade more frequently, trade bigger positions just to cope up with your losses. So a lot of poor decisions will be made, especially when you are emotional. Now, just to share with you a quick quote by one of a famous and notable trader, is that, all successful traders, you will notice that all successful traders and investors, they are actually professional risk managers, right? So another role for a very successful trader and investor is that they are also a professional risk managers. So if you read all of those famous traders and investor stories, their interviews, their writings, their biography, you will notice that they hardly talk about their trading method, because different traders use different strategies and approaches to make money in the market. But one thing for sure is that throughout their interviews, the things that they say is that they manage their risk very, very tightly. So just look at Warren Buffett, Ray Dalio, Paul Tudor Jones, George Soros, Peter Lynch, and other famous investors. Oftentimes you can see a similar pattern, is that they always stressed the importance of risk management. So you can see this focus on managing risk is not just only a footnote. It's a central theme in their strategies and also their philosophy in managing their portfolio. And that is actually their secret to long-term trading success. So in summary, risk management, it's not just a technical aspect of trading and investing. It's also a mindset and a critical component for long-term success. Because the most successful market participants understand that without proper risk management, even the best strategies can fail. So do take note on this. Now let's go on into the second topic. Here I'm going to share with you some of a few practical risk management strategies. There are a lot of strategies that you are going to learn here. So generally speaking, there are 4 key areas of risk management in futures trading. They are cut loss strategies, money management, trading strategy, and lastly, which is a very advanced approach, is the hedging. Now, I'm going to share with you each area in detail in the next few slides until topic 4. Let's begin with cut loss strategies first. Now, do you know that there are many ways to cut loss? So let me share with you how many ways are there for you to cut loss. There are at least 7 ways for you to cut loss. We have dollar-based approach to cut loss, percentage-based, time-based, technical-based, volatility-based, fundamental, and trailing stop loss. Now, can you let me know how many types of stop loss that you are currently using in your trading? If you just only use one approach, you can just type in 1. If you use 2 or 3 approach, you can just type in, let's say, 3 in the chat box. Let me know how many ways you do in your trading, so that at least I know, there are some other methods that, you can actually take into consideration how you can actually apply this in your trading. Because using one approach, it's good, but it's not sufficient. You have more, the more approach, the more options you have that you are able to do in trading, it gives you more flexibility. All right, because as you slowly progress to be a more advanced trader, you can actually mix and match and combine some or many of these strategies to make your trading more relevant to you. All right, I see majority of you has 1 or 2 approach only. Some have 2 or more, and some even have 6. Very good. Now, all of these methods, you can see they are actually how you measure losses that you are willing to take. Because when it comes to cut loss, very simple. It's just only all of irregardless of what strategy you use, right? The same way of how you're cutting losses is actually a click of button and exit your trade only. All right. So all of these methods are actually how you measure the losses that you're willing to take according to the market or maybe your trading size. So let's go through the first one. The first method is dollar-based approach. This is the most basic cut loss strategy, the dollar-based approach. Now, this is the easiest and commonly used approach because of its simplicity. Now, dollar-based approach is a cut loss strategy that involves setting a fixed dollar amount as your maximum losses that you are willing to take on a particular trade. So once this loss level is reached, you close your position to prevent further losses. So let me go through a simple process how you can actually work on this, because all of the methods also follow this same process. So step number 1, you need to determine what is your risk tolerance. So first thing first, you need to decide what is the maximum amount of money you are willing to lose on a single trade psychologically. Okay, you need to look at yourself to measure against your wallet size, whether you are willing to lose that much money or not. And this should be the amount that you are comfortable with and you can afford to lose without significantly impact your overall portfolio. So how you can do that is just ask yourself, are you comfortable with risking losing $500 or not? Are you comfortable with losing $600, $700, $800? You need to find out what is the level that psychologically and financial wise that you are comfortable to lose these losses. Now, step 2 is that you need to set the dollar cut loss level. So once you determine your risk tolerance level, you need to set your cut loss level based on the dollar amount approach. So for example, if you're willing to lose $500 on a single trade, so this becomes your cut loss level. And thirdly, once you know your how much you're willing to lose, you need to calculate what is your stop loss or your cut loss level to determine where to place your stop loss order, or what are the price when the price hit it triggers you need to cut your losses immediately. So later I will share with you some examples how to calculate your cut loss level. So once you are able to place your stop loss, so this is where you let your trade to run by itself, and then all you need to do is actually stick to your plan, because discipline is very crucial. Once your stop loss is set, you must stick to it without adjusting it to avoid further losses. So this is to help you to maintain your control over your losses and prevents emotional decision making. So the benefits for dollar-based approach is that it's very simple for you to understand. It prevents you large losses and reduce your emotional trading. However, this approach, it has disadvantages as well, because when the market is in volatile markets, especially high volatile markets, if your dollar-based approach is setting too narrow, the stop loss can get triggered by temporary price movements and causing you to exit your position prematurely. All right. So this is the poor thing about using dollar-based approach. Now, a simple quick example. So let's say you fix a dollar amount that you're willing to lose in a trade, $500. So what you need to do is that you need to convert it into how many points for you to cut your losses. So let's say for FKLI, as you know, per point for FKLI is $50. So you take your $500 divided by $50. So that would be equivalent to 10 points. And let's say your entry price is it's a long position. You buy at 1,600 level. So you minus 10 points, your cut loss level would be 1,590. Similarly for FCPO, 1 point is 25 dollars per metric ton. So you take $500 divided by $25, so it would be equivalent to 20 points. So same thing, if you enter at a price buy FCPO contract at 3,800, so your cut loss is you need to minus 20 points out from it, so it would be 3,780. Okay, are you guys able to follow this so far? Because it's a very simple calculation. If you're able to follow this, you can type in yes in the chat box so that I know you get the simple calculation here. All right. If you still do not know how to do this simple calculation, then I strongly suggest you to, enroll yourself into Saturday's LLF online workshop, so that, there in the online workshop, we will go through all of these basic calculations that you must understand. So this is dollar-based approach. Now, second method is percentage-based. Similar like dollar-based, you in percentage-based cut loss, you fix a fixed percentage of your position value that you are willing to lose. So the process of how to implement the percentage-based cut loss is exactly the same as the dollar-based approach. The difference is that instead of using a fixed dollar to set your cut loss, here you will be using a percentage to calculate your dollar amount. Now, I have a question for you. You can just type in yes or no in the chat box. Can you use the commonly used method of 2% rule to do your cut loss in futures trading or not? Now, I understand there are a lot of articles over the internet saying that 2% rule, general rule of 2% rule to do your cut loss. Can you use this 2% rule to do your cut loss in futures trading or not? There's no right and wrong answer. Later, I will reveal what is the answer for you so that you can see whether it makes sense for you to do this 2% cut loss or not. Great. Now, let's have a look how we do this 2% rule. So let's say if you're willing to cut your losses 2%. So again, very simple. Let's say if you have your trading account is $20,000. So what you need to do again, you need to reverse calculation to find out how many points that you can to calculate your cut loss level. So for FKLI, your 2% losses would be, now we are not using fixed dollar. We want to calculate in terms of your, your futures trading account. So we use 20,000 to times 2%, and that would be $400 to lose per trade. So here $400, we need to convert it into points. So divided by $50 per point. So for FKLI, it would be 8 points only. It's very tight range for you to cut loss. So for FCPO, your 2% losses again is $400 $400. Convert to points, it would be 16 points only. So you can see, compared to using a fixed dollar amount, it can be very your cut loss range can be very tight. And some of you might be saying, hey, instead of using 2%, maybe you can keep increasing to, let's say, 5% or even 10%. But one thing that you need to take note is that as your trading account gets smaller, right? Let's say from 20,000 you make losses to become 18,000, 16,000. Your percentage value for dollar value, right? It can keep going smaller and smaller. So likewise, when you keep making money, your trading account grows, your percentage in terms of dollar would keep growing as well. So for a small account, this percentage-based cut loss is actually not recommended, because it makes very little sense, and your cut loss range would be very tight only. Okay, so the benefits for percentage range is that, yes, it gives you a consistency in terms of fixed percentage. However, the condition for using or utilizing this percentage base is especially very useful for a large trading account. So for example, $100,000 and above. Okay, as you grow your trading account to become very large, then percentage based cut loss would actually make better sense. Now the third method would be time-based cut loss. Now this is very simple. You exit the trade after a specific time period if it does not reach your goal or any desired outcome. So for example, if your trade does not move in your favor within 2 days, you will exit your trade. Okay, so this is actually something like for intraday traders. Intraday traders, it's actually one of a time-based approach. At the end of the day, I would exit all of my trade, whether is it long position or short position. So let us go through another quick example here. Is that, let's say if you are a swing trader, and the rule that you set yourself is that you are willing to hold for 5 days only. Okay, so let's say you enter a trade during Monday morning, and you limit yourself into you are willing to hold a particular trade for 5 trading days only. If within these 5 days the trend does not goes up or comes down or to what is your expectation, you would exit your trade completely. Okay, so what you would do is that at the end of 5 days, during Friday, you close your position, whether it is profitable or not. So of course, the benefit here is that it minimizes your exposure in the market. You don't have to hold your position for up to 1 week, 2 weeks, 3 weeks, or even hold your position overnight. So this actually reduces your exposure, because the longer for some traders is that risk to them is that the longer that they have position, their commitment in the market, as long as you have position, they feel stressed. So time-based approach is actually something that you can consider to minimize your your stress level in the market. Now, of course, there would be drawback here, is because if after 5 days you exit the trade, so potentially you may be exiting you may be having a premature exit, especially if the market, the trend is actually very strong. If a trend lasts for 2 weeks, 3 weeks, or even 4 weeks down the road, you are just only able to capture the first week trend only. Okay, later on the subsequent period, you might missing the trading opportunity. So this is the drawback for time-based approach. So very simple, the condition for time-based is that you can fix yourself in a specific period of time. So for intraday traders, you can also use this time-based approach in terms of maybe like 5 minutes or 10 minutes. If the trade does not if the market does not trend within 5 minutes or 10 minutes, you exit a particular trade. Okay, so you can see time-based approach is actually quite flexible across different timelines of strategy. Now, the fourth would be technical-based approach. This is actually using technical analysis, especially you can use technical drawings like support and resistance levels, or technical indicators such as moving average to do your cut loss. Now, very simple, let us go through a very simple chart here. So let's say, for example, you enter at this day in this red candle. So your entry price would be the closing price, for example. So you are using technical analysis. So what you want to do is that you draw trend line or support resistance levels. So in this example, let's say we draw a support level. So here, your support level would be your cut loss level. Of course, you need to measure against the distance between your entry price and your cut loss level. What is the difference, okay, in terms of points or dollars, so that you are able to see, you reverse calculation, what is the maximum dollar amount that you are willing to lose. Okay, if you are willing to lose that much, then and you are comfortable with it, then you use this technical based approach. So of course there are several conditions for you to able to apply this technical based cut loss method. Number one, you need to be proficient in technical analysis to have a good and meaningful interpretation. So what it means is that when you draw your line, you are able to identify the trend line, support and resistance line correctly. If your technical analysis knowledge or your competency level, it's not up to a standard yet, so sometimes you might be drawing line that is not meaningful, or if you're drawing line that is that you're not comfortable with. So first condition is that you need to be at least be proficient in technical analysis to be able to use this approach. Second condition is that your trading strategy is mainly based on technical analysis. So whenever possible, try to backtest your trading strategies and your cut loss to see its effectiveness, to see whether your overall strategy and your cut loss method, whether over a long run, at least for the past 1 year or 2 year, whether does it make sense for you to continue use this method of trading strategy with this method of cut loss. Now another example on technical based cut loss is actually using technical indicators. So now we practice on using moving average. So this is a typical chart that is, you can see the blue line is actually your moving average line. So let's say on this particular day, the red candle, you enter a long position trade. Okay, you buy a futures contract. So how you set your cut loss level is that you follow your technical indicator. Here, you will just follow your moving average. Okay, so your moving average line would be your stop loss level. So when the price, let's say when the price goes below your moving average line, so this is where you cut your loss, your long position, and get out of your long trade. All right, so again, using technical indicator, whatever indicator, whether you use Bollinger Bands, moving average, channels, or some other trend following indicators here. So again, you need to measure how far your entry point to your stop loss level, so that you know what is the gap between whether you can accept that magnitude of losses. So if it is within your acceptable level, then you can take the trade. If the loss is beyond your risk tolerance level, then you can pass this or skip this particular trade. So the good thing about technical analysis or technical based approach of cut loss is that you can have a consistency when it comes to application. All you need to do is actually strictly follow the technical indicator, strictly follow your technical analysis, because your technical indicators and the lines that you draw is actually uh, based on the market conditions. It aligns with the market behavior. So it takes into account of the changes of the market behaviors, of the market patterns, so that it allows you to have a more strategic exits and strategic cut loss. All right. Drawbacks for this method is that sometimes it can be complex. You need to have a good understanding in technical analysis, and of course, the drawback with technical analysis is actually sometimes you will have a false breakout. So which means, let's say for example, support line or moving average line, false breakout means the price breaks your support level or your moving average, and then it goes up again. Okay, so this is what we mean by false breakout. So this happens due to market volatility. So it may be again causing you to have premature exits. Now, the fifth approach, volatility based, a lot of speakers shared on volatility based. So here I would want to cover this as well so that you understand how it actually works. So this is actually based on the volatility of whatever product that you trade. If you trade FKLI, your volatility base is actually following the FKLI volatility. If you're trading FCPO, it will be following FCPO volatility. So for example, in a high volatile market, you will be setting a larger stop loss. In a low volatile market, you will be setting a narrow stop loss. So how do you measure volatility here is that, of course, we will be using mathematics to do that. You can use technical indicators because, as you know, technical indicators are actually derived from mathematics as well. It's a tool that you can use also. So here are the few commonly used volatility-based indicators that you can use, which is average true range (ATR), standard deviations, and Bollinger Bands. So let me go through a quick example how you can actually use ATR exits. So again, a very simple the same diagram, same technical chart. So let's say you enter at this price, you know your moving average there, and of course here we will be inserting a ATR indicator. So of course in ATR indicator it depends on it has different parameters. It would be good for you to do a back testing. So some trading platform, they have their own default parameter of ATR. Some 14 days, some is 20 days. So you need to find a back test to find an ATR level that you are comfortable with. So this example, we will be using one-time ATR. So here, once you know your entry price, second thing is that you need to know what is your ATR level. All right, so you can see this ATR at the end of this line, the ATR level, when you move your mouse cursor over, you can see its ATR level is actually 72 points. Again, how you can measure or calculate your cut loss level is very simple. You know one-time ATR is 72 points. You know your entry price. So your entry price minus 72 points. So this is where you will be setting your stop loss level at 3898. Okay, so you need to know whether you are comfortable with using this volatility base of stop loss level, because you can see at this period of time you are actually using ATR 72. All right, and if during high volatility markets, you can see the ATR is also pretty high. So you need to see, let's say if the ATR is 100, ATR is actually 100 points, so which means you need to cut loss 100 points. Are you comfortable with cutting losses 100 points or not? So these are the things that you need to ask yourself and see whether you have the risk tolerance, whether it makes sense for you to do that or not. Because irregardless of what cut loss methods you calculate, the most important thing, okay, the general rule of thumb is that you personally need to be at least mentally, psychologically, or emotionally be comfortable with taking that losses. All right, so the benefit of volatility base is that it adjusts according to the market conditions. It adjusts towards the market volatility. So it is also able to reduce the premature exits. So you during normal market volatility, normal market fluctuations, you will not be easily get swing out too easily. However, the drawback here is that especially when the volatility is large, you need to be able to absorb a larger risk. You need to cut your losses more, and also you need to prepare more money in your trading account during a high volatility period. Now, number six, fundamental base of cut loss. Very simple. When you look at fundamental analysis, because fundamental analysis, there are too many factors, right? So you need to set a rule for yourself. I do not know what rule or what indicator that you will be looking at, or combinations of indicator that you will be looking at. So very simple speaking is that when you look at fundamental factors, is that whatever data that comes out, you don't like the data. Okay, for example, if you are trading FKLI, you see that the Dow Jones Industrial Average is actually down by 500 points. Unemployment rate is actually increasing. Uh, the tech sector or banking sector is having a retrenchment. You don't like the data. So this is where whatever position, especially uptrend position, you buy the long position, you do not like it. So what you can do is that you just cut out, get out of that particular trade that is not in your favor. You do not have to wait until your stop loss is actually triggered. As long as the data comes out, you don't like it, you just exit your particular trade. Okay, so very simple is that fundamental based approach of cut loss is actually very data driven. So it helps you exit positions way earlier uh, compared to other people, because it does not really depends on technical analysis or until your cut loss is really when you're actually facing losses for you to trigger your losses to get out. Because once data is not as your expectation, you immediately get out of your trade. But challenge with this approach is that, you know, fundamental data, it is not a real time, you know, it takes time for fundamental data for it to publish. So sometimes there may be lagging time lag for data to come out. So this is actually the challenge for fundamental analysis. Another thing is that sometimes when we look at fundamental analysis, you need to be able to interpret the news or the data correctly. So last thing is the trailing stop loss. It goes by dynamic stop loss. So very simple is that, you know, we go through a simple example so that you understand how it actually works. So let's say you enter at this price 3920, and initially you have a stop loss of 3870. So when the market has already trend up, so it means you have already, your long position has profit already. So the current market price is 4280. So you can actually set, you know, move your stop loss instead of putting at 3870. You can actually move your stop loss level up a little bit higher. Here, for example, 4080 or any price below the current price. Let's say 50 points or 100 points below your current market price, so that it's easier for you to, you know, at least it protects your profit. All right. So I've already shared with you the cut loss strategies in terms of managing your risk. Another approach is actually in terms of money management. It's very important for you to manage your money because it helps you preserve your capital. It aligns with your risk tolerance and trading goals. And also it reduces your emotional trading. But one thing about money management is that you need to treat, you know, when you do trading, you need to treat trading is like doing business. You need to have a lot of capital in your trading account. Okay, it's like running a business. Having more money to run a business is better than having less money. Am I right? Because no matter how good your business is, whether you have a very good product, good services, good management, or good business idea, as long as if your cash flow is not there, if you don't have sufficient cash in your business, which means you are actually undercapitalized. So no matter how well your trading strategy is, if your trading account is having too little money, your trading strategy is unable to realize its potential. So always remember that when it comes to money management, it's also a part of risk management that you need to take into consideration. Okay, so how much money or capital that you really need in your trading account is that more is actually better. Never ever undercapitalize your trading account, and most importantly, never ever trade with scared money that you cannot afford to lose. For example, like, you know, money for wedding, money for retirement, money for medical expenses, money for to pay your mortgages, to pay your bills, money for your kids' education. So all of those scared money is actually adding pressure for you to trade. So if you're trading with scared money, my best advice is that please don't trade at all, because you are putting yourself into a situation that is unfit, mentally unfit, emotionally unfit for you to do trading. So if you can't risk it, don't trade. Again, money management, another area is actually on position sizing. In fact, position, it's actually depending on how much money you have in your trading account. If you have more money, of course, you can, trade bigger size. If you have too little money, you trade less contract. How much you trade your position, it's also again depending on your trading strategy. Some strategy it's very short term, so they may be able to trade more. Some strategy it's, for example, going on volatility based strategy, so their position sizing may be go on a very small position, but what they capture is actually capture a very huge and big trend. So always start small, slowly increase your position based on your trading performance. I understand for a lot of traders is that, your primary goal in trading is that you want to make as much trade profit in from the market, am I right? But one thing is that please have some common sense and logic is that if your trading performance is actually not performing, so it does not make sense for you to actually increase position, because it's like again like doing business. If a product or the product is actually not performing, you do not want to putting in increase more stock for that particular product, am I right? So same thing goes for trading. If your strategy is not performing, the performance is not ideal, so this is where you actually can keep revising your trading performance. If a performance is actually ideal, it's something that you like, so this is where you can slowly increase your trading position. Now, last thing on risk management is that, which is also trading strategy. Uh, the first level of managing risk is actually your trading strategy. Okay, so before you decide how much to do your cut loss, what cut loss method that you want to use, number one thing that you need to do is actually to make sure your strategy actually works. Why? Because it doesn't really matter how much money that you have in your trading account, how much arrow that you have, or how much bullet. If you simply shoot it in the market, you're actually donating your money to the market. Okay, so of course, first look at your trading strategy to see whether it works or not before you plan your cut loss method. All right, so let's in this topic, let's go into the fundamentals of hedging so that you understand what is hedging all about. Now, simply speaking, hedging is like an insurance for investment. So it's a strategy for you to protect yourself against potential losses in other investments. So I'm going to share with you in topic 4 how you can actually do that with examples. So what you need to understand is that hedging is like insurance. The main goal is actually not primary goal is actually not to make money. The primary goal is actually helping you to reduce your risk. It's not totally eliminate all of the risk, but at least you have a reduction in risk. So later on with examples, you will be able to understand that better. So simply speaking, hedging it's like insurance policy. In fact, hedging is actually quite an advanced risk management approach, where in fact not just only helping you reduce your it's not just only for cut loss. You can actually protect your stock portfolio from that, especially from unexpected events. All right, so later on I'm going to share in topic 4, I'm going to share with examples so that you know how it actually works through hedging. Now, I believe you maybe have some memory about what actually happens, I think last for the past 30 days, which is 5th August 2024. Does any one of you still remember what happened this day or not? It's actually Monday. Probably, news might actually call it as a Black Monday. So FPMK's LCI is actually down by 75 points. Not just only in Malaysia, in fact, it's actually worldwide. Japan, Hong Kong, UK, US. It's actually quite a Black Monday for everyone. So there is no chance for you to sell. There's no chance for you to get out from stocks. If you want to get out, you need to sell it at a very unfavorable price. Sometimes you have to sell many few levels down here. So how you can do that is that let's say if you do not have any hedging, so if you have a long position, which means your stock portfolio is actually having buy only, right? So on your scale, you have one side losses only. However, if you have hedging, so which means in futures you have, let's say, a short position, your skill is actually can be actually balance it out. So one side losses, another side having a profit. So your losses can actually have a offsetting your losses. So later with examples, you will understand how does hedging actually works. Now, of course, hedging is not only applicable for in trading. In fact, airlines industry, they also do hedging using futures contract. Why? Because if airlines they are selling their ticket very advanced, right? 6 months, 12 months is in advance. But 12 months in advance, they are not quite sure what is the fuel price. Am I right? So if the fuel price 12 months later is actually very high, so their profit margin will be affected. So how does airlines reduce their risk or help them to protect their profit margin is that airline industry, they use futures contract to hedge their fuel costs. Okay, so on one side they need to buy the fuel, jet fuel, physical product, okay, because they really use fuel, right? On the other side, they long crude oil futures contract. So when fuel price goes up higher, their futures contract, long futures contract, they actually having a profit. So of course on the physical trading side, they have to pay higher price, right? So higher price, and then on this side you have profit, so both of them can actually net off each other. So you can see the benefits of hedging is actually for you to minimize your losses, to also protect your profit. All right, so simply speaking, hedging is help to reduce your risk, to protect you against unfavorable price event. Of course, the objective is not to make any profit. So for example, if you do not have any hedging at all, so let's say last month, Black Monday, your equity, your stock portfolio, overall portfolio having a loss of 15%. Okay, your total stock portfolio is having a loss of 15%. And let's say you have a hedging position in the index futures market to hedge against your down in your stock portfolio. So here you can see the net effect is that you lose lesser by 10%, or in other words, it's actually a gain of 10%. You know that making a gain of 10% is actually really not easy in trading. So in fact, hedging actually gives you a lot of benefit. Now, if you are still not quite convinced why helping reducing losses is actually a good risk management strategy, you can look at this loss recovery table. I believe some of you might be quite familiar with this table. So what it means is that how much you, on the left hand side is how much you lose on your capital, let's say 10%. You need to make 11% of gain in order to break even from your 10%. So again, if we move down, you can see if you lose 10%, 30% in your portfolio, you need to make 43% in order to recover back all of your previous losses. If you lose 50% in your portfolio, you need to make 100% to recover your overall portfolio back to the original level. So you can see with hedging, right, you lose lesser by 10%. In fact, you do not need to, you are actually on the top of this scale. Okay, if you do not do hedging, maybe you have already fallen down at the bottom scale. So you can see with hedging, not only it reduces your loss, you can also protect your portfolio value. All right, let us go through with a quick example, a practical guide on how you can actually do use hedging to protect your stock portfolio using index futures. In the previous LLF webinar session, I did share about one trading idea that you can use using futures contract is that you can actually use future contract to do hedging or getting out from your stocks completely. So what you can do is that I understand here is the strategy very simple. It's actually take a short position in your index futures. So later on, I am going to share with you how many contracts that you need to calculate in order to get out of your stocks completely and also to hedge your overall portfolio. So to simply speaking is that I believe for those of you who especially if you invest in stocks, regardless of what strategy that you do, probably you have a belief that you are actually investing in undervalued stocks. So you might be afraid that when the market comes down, your stock may not come down in value. But in fact, sometimes, the general market come down, right? Your undervalued stock might go up instead. And sometimes, especially during downtrend or negative sentiment, like on that day, Black Monday, it's just only a 1 or 2 days Black Monday event. So everyone is very panicked. There is a lack of liquidity for you to get out, because during a panic situation, buyers do not want to buy, because they do not want to commit themselves in the market. They can bargain more because they want to buy at a way lower price. So if you already hold stocks in your position, it's very difficult for you to sell your stocks or get out from stocks. So if you want to get out, you can, but you need to sell at a very unfavorable price because of low liquidity. So what you can do is that you can actually short the market very easily using futures contract to hedge your portfolio. Of course, the timing of hedging is actually to hedge before bad things happen. So there is usually a sign before bad events happen in terms of technical indicators, or even in terms in the forms of news. So for example, you can see some of the signs like market slowing down, the sentiment is turning sour, or based on your interpretation or analysis of the fundamental factors, the upside potential, it seems like quite limited. So this is the time where you can actually take a hedge position before bad things happen. So it's like buying an insurance policy. You buy insurance before accident or disaster happens, right? You don't buy insurance when accident already happened, then that will be already too late. So how you can do hedging is that, for as retail traders or retail investors, you can still do hedging by taking index futures. So we have several index futures like FKLI, FM70, and F4GM to hedge against the downward movement for your stock market. So this is the formula how you can calculate what are the number of futures contract for you to hedge. So the formula is very simple. On the top part is that you need to know at that point in time before you do your hedging, what is your total stock portfolio value, and then divided by your futures price times your multiplier. So let us go through a quick example to see how you do your calculation. Now, very simple. Let's assuming before Black Monday, okay, or currently maybe you say today the market is very high, you are not quite comfortable, you might be thinking market is coming down. So today your total portfolio value is 200,000, and the current FBM KLCI is 1,600, and FKLI it's also 1,600. So you anticipate the global sentiment tend to be weak, or for whatever reasons, the data is not strong, GDP is weakening, or any other factors that seems relevant to you. So you want to hedge your stock portfolio against downside. So how you can do that is that, number one thing is that you need to be able to calculate how many contracts that you need to hedge. And later on, I will be showing with you what is the profit and loss when it actually happens. So again, you follow this formula, very simple. What you need to do is that you already know at the point of time before you hedge, your stock portfolio value is 200,000. And on that day itself, before you execute your futures contract, the futures is actually trading at 1,600. So as you know, for FKLI, per point is $50. So you take 1,600 times 50 points. So you take 200,000 divided by this. All right. So the answer that you will be getting would be 2.5 contracts. So of course, when we trade futures, we always round it down to the round number, which is 2 contracts. So what it means is that you will be protecting your whole 200,000 stock portfolio using 2 contracts only. Okay, and this is how your profit and loss will actually work. So the first line is that let's say the FVMK LCI is actually down by 5%. Okay, for example, on that day itself, Black Monday, last month. So your impact on your stock portfolio, 200,000, is down by 5%, right? So here you have a loss of $10,000. Your overall stock portfolio value is down by 10,000 ringgit, and because you have a short position in your index futures, so 1,600 times 5%, so that would be 80 points. So 80 points times $50 per points times your 2 contracts. So in your futures trading account, you will be making 8,000 ringgit of profit. So you add these two things together, it would be, your net impact would be only $2,000 losses. All right, you can take a snapshot of this page. Take your time to understand how does this hedging calculation works. All right, so you can see the benefits of hedging is actually not for you to make money overall, but at least it helps you to cover back some of your losses from futures trading. At least the net impact towards your overall wealth is actually not having a significant losses. You can see the net impact is actually reduced to 2,000 only. All right, so one thing here that I would like to highlight to you is that here, although our calculation is 2.5 contract, we always round it down to 2 contracts. We do not want to round up to 3 contracts. Why? If you round up to 3 contracts, it means the additional 0.5 contract, so 2.5 plus 0.5 will be 3, right? The additional 0.5 contract is actually taking an exposure of short position. Okay, so you if you have time, you can actually do your calculation. Let's say how it works for 3 contracts here. Okay, so I believe throughout this simple calculation, how does hedging actually works for your stock portfolio. Right, so very simple. What you need to do is that you need to know before you hedge what is your overall stock portfolio value, and then you need to find out what is the FKLI currently trading. If currently it is trading at 1650, so you take 1650 times 50, and then you calculate how many futures contract that you would need to short. All right, so on one side your stock portfolio is actually long position, on the other side your futures contract is actually having a short position, so both sides actually will balance the scale. So simply speaking, today I have already shared with you some of a few key things, is that it is very important for you to manage risk and control risk in your trading. And I have shared with you some of cut loss strategies, how you can do that based on dollar, percentage, time, technical volatility, fundamental or trailing stop loss. And of course, there are several approach of managing a risk, which is also looking at your money management, your trading strategies as well. And lastly, hedging. Of course, when you have more trading excess money in for you to hedge, you can actually apply hedging to protect your stock portfolio, because hedging can definitely help you protect your portfolio from downside risk, especially when when everyone is panicked, you want to sell your stock is also very difficult. So hedging can help you to protect your stock portfolio from that. All right, so that's it for today. I thank you for your participation. Again, if you have any questions that is related to today's topic, I welcome you to ask it in the Q&A box section.
Siwa, for your informative presentation. I believe by now all of you understand what is hedging, how do you hedge, and you also understand what is risk management and how do you manage your risk. Like for example, how do you cut loss, how how many methods are there available for you to cut loss. Now, before we proceed, if you have any question, you can start to type your question in the Q&A box. Remember, please do not type a question in the chat box because we are not able to pick up your question via the chat box itself. So how do you send in your question? You just need to click on the Q&A box, type in your question, and send it to all co-hosts. Meanwhile, while waiting for your question, I appreciate your help by providing us with your feedback. This feedback is very short, less than 1 minute. You should be able to finish because this session is very informative and is very helpful for your understanding. We hope you just do us a small favor by providing us with your feedback. How do you provide us with the feedback? There are two methods. Either you can use your mobile phone, scan on this QR code, or else in the chat box, our admin already put in the link. You can click on the link to access to the feedback form. I repeat, two methods. Either you use a mobile phone, you scan on this QR code, or else in the chat box, there's a link. Click on the link to provide us with your feedback. So we are going to stop for 3 seconds for you to provide us with your feedback. Your feedback will help us to provide a better session in the near future. So either you click on the link or you scan the QR code. If you have any question, you can continue to submit your question in the Q&A box, and subsequently we will get CY to answer your question. Last 20 seconds. Okay, I saw some of you already submitted your feedback. For those already submitted your feedback, really thanks for your feedback. We appreciate a lot. For those who have not yet finished your feedback, you can continue to provide us with your feedback. And for any feedback, you can submit in any of the languages, English, Malay, or even Mandarin as well is okay. So just provide us with your feedback. Now we are going to continue with our Q&A session. Siwa, are you ready? I'm going to pick up some of the question for you to answer. Now, the first question is, are we allowed to hedge in FCPO market?
Okay, that's a good question because I did not cover FCPO market, right? So basically speaking is that because we don't invest in any there's no stocks in FCPO. We have stocks in plantation, we have plantation stocks. So whether we can hedge in terms of that, is that the answer, I would say it would be yes, provided you invest in plantation stocks. So how it actually works is that, again, same thing like how we hedge our equity portfolio. So when, let's say, FCPO comes down, it means your plantation companies might not be able to sell their crude palm oil or their palm oil products at a higher price. So which means their earnings might be reducing, and therefore it may affect their share price. So in terms of hedging your plantation stock, is that plantation stock not performing well because of FCPO coming down, right? So this is where you can actually have a short position in FCPO to hedge as well. And that is one way to look at it. And another way to look at it is that I remember the last LLF webinar topics I mentioned, one of the trading idea is actually FCPO can be used as a diversify strategy, because FCPO is considered as a different asset class. It's considered as a commodity asset class. So there are times FCPO does not really follow how does the stock market does. And again, your plantation stocks might not also follow the price movement of FCPO. Am I right? So, for the past 2-3 years, you can see FCPO might go up to over 6,000, 7,000 ringgit, and plantation stocks might still not be performing. So FCPO can also be trading FCPO as an outright, as a way of diversifying your whole trading portfolio. So at least if your stock is not performing well, you have one additional different asset class, which is FCPO. Your commodity asset class is actually having performance that is not correlated with your stock portfolio.
Oh, how about from the other direction, let's say for institutional or corporate clients, because the question doesn't specifically mention that it's meant for retail only. How about using FCPO to hedge their physical CPO?
Okay, that's a very good one, because FCPO, especially for those commodity futures, it's not just only for FCPO, crude oil, gold, or any other futures, because futures is actually the futures market. If you were to read about the history of the futures market, is that it is being designed in a way to help those farmers, those commodity producers and commodity sellers to hedge against their commodity price movements. So for example, like FCPO, not FCPO seller, the CPO seller, those plantation milling companies, they will be producing crude palm oils. So CPO price going up is actually advantage to them. However, when CPO price comes down, it is actually very disadvantage to those plantation those palm oil milling companies, because they are actually CPO seller. So how they can protect themselves against selling at lower price, how they can protect against profit margin squeeze, or protecting their CPO inventory value, they can take FCPO futures to hedge against downward price movements. So this is actually from a perspective of those sellers of FCPO. Same thing for those buyers of FCPO, which are those palm oil refinery companies. They want to buy FCPO. They want to buy crude palm oil as low price as possible. So they can actually use the FCPO to take a long position to hedge against price increase in the crude palm oil physical product. So you can see, which is why the commodity futures is not just only retail traders, because large portion of a major market participants in commodity futures are actually those who are actually doing trading physical products in the commodity market.
Okay, the next question a bit long. Maybe the question might not be correct. Maybe you can voice it out. The actual question is, this is the real situation of shorting FKL to hedge the stock portfolio. So his question is, recently FKL went up due to nice bull from banks stocks. If your stock portfolios does not have bank counters, these hedging strategies won't work. What is your view on this situation?
Okay, this is actually quite a advanced question. It's actually a very good one. So of course, when we do hedging, so of course we want to protect our stock portfolio from coming down. Am I right? So there is one study saying that whenever the general market is coming down, even though your stock portfolio might have those low beta counters, or stocks that is less sensitive towards market price movement, the beta will actually tends to approach one. So which means during bad market situations, for example, like last month, 5th of August, during Black Monday, when there is a shock, right? Investors tend to think those investors, especially retail investors, are generally already panicked. So they don't really care about what is the price in the market. What they want is they want cash. Okay, whatever price it is, they will just sell in the market. So hence you can see a lot, not just Malaysia, but globally is actually it seems like a market crash. So this is where, even though you do not have bank counters in your stock portfolio, the hedging can be done as well, because during a general market downturn, right, even the stock in your stock portfolio is not sensitive to the general market when it goes up, but when it comes down, right, the whole thing will be dragged down together. So which is why hedging is actually one of the good thing to protect your portfolio. Now, the challenge here is that sometimes you may have profit with it also. So just take it as a bonus from your hedging lah. Okay, so when you have profit from your hedging and you are comfortable with it, so this is where you can take profit from your futures trading by closing a short position, and then wait for another opportunity. Maybe you can long futures, or maybe you can take the excess profit to put it over to stock trading account if you like stocks.
Okay, due to time limitation, we're going to take the last question, which is more relevant to today's topics. So the question is, after we hedge, will the crude palm oil be sending to us?
Okay, when we hedge, actually crude palm oil is okay. This is nothing to do with hedging. Okay, this goes back to the very basic principles about trading futures. If you are holding your contract, let's say a general retail trader, we will be trading the third active month, am I right? So if you keep holding your contract until the third contract month becomes second month, and then spot month, and then when it expires, then yes, for retail traders, generally you will be required to make delivery or take delivery for crude palm oil. But for retail traders, generally, for futures broking side, they understand you are retail traders. You have generally for retail traders, they have no intention to take delivery or make physical delivery for crude palm oil. So this is where 2 weeks before the spot month contract expiry, there is one thing what we call as the first notice date. So which means your futures broker would notify you whether you have intention to take delivery or not. So this is where you may get a call from your futures broker. Otherwise, they will help you close your position also.
Okay, thanks Yua for answering the question. Now, let me wrap up for this evening. As I mentioned to you, if you submit your feedback form, you can scan the QR code, or else in the chat box, there's a link provided. We welcome all your feedback. Even after the end of today's session, you can still continue to submit your feedback form. Now, before I end, just for information, upcoming every Tuesday, provided if the Tuesday is a public holiday, we are going to have different topics covered by different speakers. Upcoming next Tuesday, we are going to have a Mandarin topics, followed by 24th of September, it will be a Malay topics. And on 1st of October, we are going to have this topic called Hikaneshi and Directional Mastery in Futures. If you're interested in any of the topics, you can scan this QR code and register, or else in the chat box, there's a link. You can copy the link and you can register at the end of today's session. Now, once you click on the link, you're going to access to our calendar, select the Tuesday session and select the session that you would like to access to it, and you can click on the particular session and register accordingly. Not only Let's Learn Futures webinar series, we also have Let's Learn Futures online workshop provided by Bursa Malaysia as well. So upcoming, we are going to have the 21st of September, we are going to have an English session, followed by 9th of November, a Malay session. So what you need to do is, these two topics online workshop is not meant for everyone. This is meant for those who do not have ideas what is futures trading, those who have not yet started in futures trading. I strongly encourage you to participate in these two online workshops so that we can handhold you from A to Z for you to kickstart in your futures trading. So online workshop 1, each session we're going to have a 3-hour session from 9:30 to 12:30, and afternoon session will be 2 to 5 p.m. So every session we are going to accept up to 150 to register, and on the day itself, we are only going to limit to first 50 online attendees to participate on the session, because we are going to really go through everything, and also we are going to run a trading simulation for you to understand exactly how do you place, for example, your first futures contracts. Now, once you click on the link, it comes to our events calendar as well. You just need to select the Saturday itself on the 21st of September and select the session that you would like to attend. I strongly encourage you to participate in the first online workshop before you join the online workshop 2. Now, another part is you can access to bursamarketplace.com/mkt/dts for derivative trading simulators. It's a simulation trading platform. This is provided by Bursa Malaysia as well. Last part, I just want to introduce to you the Bursa Academy. Bursa Academy is a comprehensive one-stop e-learning platform. How can you access to it? You can scan this QR code, or else you can access to bursaacademy.bursamarketplace.com. So this brings us to the end of our session, and really thanks for your participation, and thanks to our speaker for today, CY, and I'm going to see you in the near future. Thank you very much, and good night. Bye-bye.